Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. Alternative assets have become very popular as the benefits they bring to investment portfolios are more widely known, and accessibility has increased as innovation has made it easier for investors to gain access to alternatives through different investment vehicles. I have on an industry expert to share his insights into the world of alternatives and some key considerations financial advisors should think about when communicating with their clients about alternatives. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. I am very honored and excited to welcome Aaron Filbeck. Aaron is the managing director and head of UniFi by CAIA, or Chartered Alternative Investment Analysts Association. Aaron, thank you so much for coming on the show. Can you tell us a little bit more about yourself and UniFi by CAIA?
Yeah, absolutely, Ryan, and thanks so much for having me. It's a pleasure. Looking forward to the conversation. So a little bit about me. So I started my career into the wealth management space. So I was on the investment side of an RIA, doing manager selection, due diligence, portfolio construction, asset allocation, all the fun analytical stuff from an investment perspective. But I also spent a lot of my time working with our advisors, client service, and interacting with a lot of our clients on what's going on in their portfolios. So I have sat in that seat, and it can be challenging. It can be very rewarding as well. But that's where I started my career, and I've been at CAIA now for about 5.5 years in a variety of different roles, from our designation program to our content and thought leadership efforts, and then more recently, over the past 3 years, have stood up this UniFi by CAIA online learning platform that we've developed here at the association. So UniFi by CAIA is an online, effectively an online academy that CAIA Association launched a couple of years ago, really geared towards teaching the private wealth management industry all they need to know about alternatives and getting into the foundations of how these strategies work, how they fit in portfolios, and then ultimately, how do you have a conversation with clients around what alternatives can do in your portfolio, and how they ultimately achieve client objectives. So tangibly, it looks like a series of online courses and certificate programs that we've developed, where we're covering kind of broad brush alternatives through our fundamentals program. Or if you want to go deeper into different asset classes or strategies, we've developed even shorter form courses that we call micro-credentials that get you a little bit deeper into things like private credit, private equity, digital assets, and real estate, and more to come. So it's a nice solution for those that are more client-facing and want to be able to articulate what alternatives are and understand the language of this industry.
I love it, Aaron. First of all, a lot to talk about. I love the fact that you were on the investment side of an RIA previously. That's where my heart is and my passion is in investments, creating optimized portfolios, doing manager due diligence, and that's what Zephyr is all about. So I love that part. And two, the education piece of CAIA, I think it's so important, especially now that alternatives are so popular. You see it in the mainstream all the time, whether it's private credit or secondary, and I've had a lot of people come on the show to talk about alternatives, and I'll be the first one to admit, I didn't really realize how many layers of alternatives there are. It's not just private equity or private credit. And talking to them, it's like there's secondaries, there's VC, there's just all these different layers to the onion. And I think education is so important.
Yeah, absolutely. And to your point, the term alternatives as an umbrella term is actually a bit of a misnomer, as I'm sure you can relate, as you've seen these different strategies. I mean, the role that private equity, and even private equity, is kind of a misnomer because you have so many different subcategories of the asset class within that umbrella. And so it's a very complex industry, but it's also a very broad industry. These strategies don't move in the same direction and have very different underlying characteristics.
It's really interesting. You brought up the term alternatives, and it's such an umbrella term, but it's like maybe we should rethink that in a way because yeah, like private equity should be like just an asset class itself based on how big it is and all the features. Let's talk about that real quick. You talked about alternatives and it's really evolved. When I was in the industry doing the investment management piece, for a financial advisor, alternatives, we relied on REITs, limited
Mm.
partnerships and stuff like that 20 some years ago. So let's take a step back and talk about how we got here today and the evolution of alternative vehicles.
Yeah, so there's a couple of ways that you can go about this. One, if you just look at alternatives, again, that misnomer umbrella term of alternatives, if you look at it even 25 years ago, the makeup of this industry was so much more singular than what it is today. It's very diverse as an industry today. So, by our measure, alternatives represent about 22 trillion US dollars in assets under management, which is roughly about anywhere from 15 to 20% of total AUM in the industry. So still a minority relative to traditional long-only equities and fixed income and money markets and cash, but still represents a sizable portion. And that makeup of the 22 trillion is made up of some of those categories we just talked about, whether it's public equity, private equity, private credit, real estate, infrastructure, hedge funds, and so on. If you rewind back 20 years ago, 25 years ago, the term alternatives was actually relatively synonymous with hedge funds. So private equity was still a small and burgeoning industry. Private credit was kind of this sub category of a little bit of hedge funds, a little bit of private equity. You might find some opportunistic managers that are in there. So the makeup was much more focused on the hedge fund space and sitting roughly around 5 to 6 trillion. So we've gone from 5 or 6 in the early 2000s to about 22 trillion here in the early 2020s. So there's been an evolution in terms of what constitutes this industry, and that evolution is both growth but also diversification within the industry. We've similarly gone through a period over the past couple of decades of how you access alternatives. There's been quite an evolution in that access point. So maybe 20, 30 years ago, and even 10 years ago to some degree, it was kind of a binary decision. If you wanted access to the markets, you could either go fully liquid in the mutual fund space and in the ETF space where you're buying liquid alts, so basically hedge fund-like strategies in liquid wrappers, daily liquid registered wrappers, or you went full illiquid. You went the limited partnership route, drawdown funds in the private markets, hedge fund vehicles in the more hedge fund oriented strategies. And then there was this gulf that was in between. You really didn't have the options that you do today. Well, since then, and these are not new vehicles by any means, but they've grown in popularity and sophistication and the ability to access it. You've had this wide variety of different access vehicles come to the market over the past 10, maybe even 15 years or so, post GFC, where as demand for alternatives continues to grow, you're getting into semi-liquid vehicles like interval funds, tender offer funds, business development companies here in the US, non-traded REITs. So you mentioned REITs being one of those access points, but you've got the four horsemen of kind of the semi-liquid fund vehicles that have now opened up the possibility of accessing illiquid markets and illiquid asset classes in a wrapper that's a little bit friendlier from a liquidity perspective and a registered product perspective. So I'll pause there, but we've seen a large evolution in both the asset classes that are available, but actually how you access those asset classes has also changed quite considerably.
Let's talk about that. That's it's such a great recap about accessing alternatives. Like I said, I think there's enough education out there and information about the benefits of alternatives, increasing the diversification of portfolios, moving that efficient frontier to their northwest corner. We could talk about that all day. But let's talk about accessing. You mentioned interval funds. I'd say past couple of years, 2 3 years, interval funds have really gotten popular. And to me, like the benefit is they have a ticker, right? Um, so that makes it easy. Then you've got more popular the ETF alternatives. Can we talk a little bit more about those? Maybe start with the interval fund because it might not be as um, known about like how what is an interval fund?
Yeah, no. So I think there's a couple things maybe on the interval fund front. The easiest and probably the oversimplified way of thinking about an interval fund is you're borrowing characteristics of the mutual fund. So like you said, there's tickers, they're registered products. So there's a little bit of a familiarity of accessing them like you would a mutual fund, but then they house the illiquid assets that you find in a limited partnership type of investment. And really, an interval fund is basically a closed-end fund, which we see on exchange traded systems, but it's just not traded on an exchange like a closed-end fund. So it's a very similar structure in that regard. So borrowing elements of both and kind of sitting in between from a liquidity perspective. So interval funds typically have periodic liquidity windows. So you may be able to invest more frequently throughout the year, some are even daily, going in and making those contributions, making those investments. But if you want to redeem, unlike a mutual fund, it's not a daily redemption process. But also, unlike a limited partnership, where you're having to wait for those distributions for multiple years, you're usually at about a quarterly or semi-annual redemption period in an interval fund. So it provides some optionality for investors who may need to rebalance. Maybe some life event comes up with their clients and they need to redeem some capital to help fund that. But it provides kind of a nice in between in terms of liquidity and ease of accessing the private markets. Now, when it comes to any of these vehicles, whether you're talking interval fund or you're talking a tender offer fund, even all the way to an ETF, there's a lot of benefits to these vehicles because they are, again, regulated. There's tickers, there's ease of access. But an important consideration is what is the actual underlying asset that I'm investing in? And does the liquidity profile of that asset match the vehicle that I'm investing in? If you are investing in venture capital, for example, it's a very long dated illiquid asset class. And that can be challenging for a semi-liquid structure like an interval fund. Might be more appropriate for a tender offer fund, which has more discretion on some of those redemptions, shares a lot of similarities to interval funds, but there's more discretion on liquidity. It's certainly not appropriate for an ETF, given the daily liquid nature of it. But you tend to see naturally there are certain asset classes and strategies that gravitate towards certain fund vehicles. So interval funds tend to be more income oriented types of asset classes. So you tend to see a lot of private credit, see a lot of core real estate, cash flow generating asset classes in those structures. You might see more private equity in places like tender offer funds, but then you're going to see more things like commodities or publicly traded REITs, publicly traded BDCs in the ETF space because of the more natural match between the assets and the liabilities.
Awesome. Such a great explanation there. And you talked about liquidity. I think we talked a lot about liquidity or being illiquid. What impact does gaining access to illiquid alternatives through ETFs have on liquidity? Does it really change how liquid alternatives are when you've got now ETFs in the game here?
Yeah, so when you look at ETFs and illiquid assets, and I would say the same thing about mutual funds too. I mean, ETFs and mutual funds share very similar characteristics in terms of their liquidity. Now, obviously, one's exchange traded, and you've got a price to NAV mismatch that occurs throughout the day. Mutual funds are a daily redemption process. But in both of those scenarios, you've got vehicles that first have restrictions on the illiquidity that's allowed within them. So In the US, these 40 Act funds, mutual funds, ETFs, have restrictions on how much illiquid assets can
Mm.
be in those funds. So 15% is the cap that you find in mutual funds and ETFs. And so right off the bat, you can't have too much illiquidity in those vehicles just due to regulation.
Yeah.
But I think a more important consideration here is that mismatch that I was talking about on the interval fund side and the ETF side, where you really need to pay attention as an investor of the underlying liquidity of the basket of securities or the assets that are being
Yeah.
housed versus the liquidity of the ETF. And I think that becomes even more important in the ETF versus the mutual fund because mutual funds can soft close. They can have some restrictions on who gets to invest in some of those vehicles.
Yeah.
ETFs today are open to everyone. And so you're investing alongside retail investors, maybe people that don't fully understand the underlying asset classes. And so paying attention to who you're investing alongside, but also that asset liability mismatch is very important.
Yeah. Fantastic. So, you know, obviously now because ETFs and interval investing, now accessibility to alternatives has really come down river. Now retail investors have much more ability to include alternatives in their portfolios than they did, say, 10 years ago.
Yeah.
What are some of the impacts that is having on alternative investing? The fact that now your normal retail investor can now get access to alternatives. How is that impacting um, alternative investing?
Yeah, so and I would maybe, and it's a bit of a nuance. I wouldn't say that retail investors are
Okay.
fully accessing alternatives like they might a mutual fund or an
Yep.
ETF. It's still very much, I think, the threshold is still at the ultra high net
Okay.
worth stage of the game. So you're not seeing a lot of individual investors, although that's changing. We're seeing some platforms that have come to market to try to open up access
Mm-hmm.
to everyone. But in terms of how it's changing the industry, I think there's a couple of ways. One is clearly the business model of the asset management community is changing. The institutional investors have largely been where these asset management companies have played. They're mostly interfacing with endowments, foundations, pensions, sovereign wealth funds, and so on. And as it starts to move into the more private wealth management space, the high net worth individual space, their business model changes slightly. They're launching new products, like we just talked about, the interval funds and more semi-liquid fund structures. They're having to think through how do I build a team around this to not only go out and fundraise, but also
Yeah.
support from a client service perspective. So it's almost a whole new business line within a lot of these organizations. So you have to think through the service side, you have to think through product structuring, you
Okay.
also have to think through content and how you market to this space. So there's a whole kind of evolution of the asset management
Mm-hmm.
space that has occurred as this democratization has taken fold. On the other side of the equation, you've seen the wealth management channel change as well. I mean, the access points have gotten easier. You have platforms that provide access and act as a nice technology solution for individual advisors and RIAs and independent broker dealers that historically may have not have had the capacity to access some of these different
Yeah.
vehicles. Going into a limited partnership takes a lot of assets, a lot of capital, and a lot of paperwork to do that. But the operational side of things has gotten a lot easier for the wealth management channel. So you've seen the connectivity between the asset management community and the wealth management community. But there's still a lot to be done. We've talked about education, but
Yep.
also just thinking through, once I understand how these asset classes work and these strategies work, how do I go about implementation? I think implementation is really the next phase for a lot of
Mm-hmm.
wealth management advisors, for investment professionals who may understand this intellectually, but need to think through, okay, now I've actually got to make those trades and make those investments. So it's had a lot of impact even beyond some of the asset management growth that we've seen over the
Mm-hmm.
past couple of years.
Fantastic. Aaron, you brought this up too a little bit in that explanation there. really from the asset management side, but on the wealth management side, yes, you have implementation, selecting what alternatives, but I think maybe even most important is communicating, the
Mm.
communication piece with clients. What are some tips you can provide financial advisors when they're communicating with their clients about alternatives and saying the importance of alternatives in a portfolio? Are there some tips you can provide them in that communication?
Yeah, well, I think first, and we opened up the episode here talking about it, not using the word alternatives. I think for one thing, it doesn't really describe what the actual strategies are. I mean, at the end of the day, private equity is equity. It just happens to be private. Private credit is credit. You've got loans, bonds. It just happens to be private. And so I think demystifying a little bit by by using certain language and keeping it simple in terms of what is actually in my portfolio. If you understand bonds, you understand high yield, you understand investment grade fixed income, well, private credit, direct lending, mezzanine debt, like all of these just fit. With obviously, there's caveats to that. There's a liquidity, there's other things along
Mhm.
those lines. But that first conversation, I think, uh, demystifying it is an important thing. I think the second thing here as well is, not focusing so much on the strategies themselves, but focus more on the portfolio. What is this going to do for the overall portfolio? And importantly, what is it going to do for the client's objectives? We're putting these strategies in the portfolio because you're trying to hit an absolute return objective in the financial plan of 4, 5, 6, 7, 8%. So, and that becomes a little bit more natural when you think about it from the public equity side. Like, you don't spend a lot of time talking about this large cap growth manager or the small cap value manager with clients. Most clients, and there's an exception, there's a handful of clients that want to get really deep into this kind of stuff, but you're not really sitting across from clients and going manager by manager and talking about how that manager works or getting into the details of the minutia of those strategies. And I think the same thing can be said for alternatives. Um, so I think those two are really effective tips. Focus less on we're putting alternatives in your portfolio and focus more on we're putting equity risk in your portfolio. We're playing more offense in your portfolio. We're looking for income in your portfolio because of the objectives that you have. And then second is that portfolio approach and less about the actual strategies or asset classes themselves. I think it's important to set that context in that conversation that way.
Yeah, Aaron, that was fantastic. And I think it's so important. Like you talk about education, well, communication is key there. And I like the idea of, you know, in this industry, we're terrible at acronyms and all that stuff, right? Like keep it simple, right? And focus on, and we talk a lot about it now. Seems like it's really evolved over the past 10 years or so. People are much more concerned about goals-based investing,
Mm,
focusing on what are their goals versus just I want 10% return so I can talk to the
yeah.
friends at the country club, and if you focus on that portfolio, achieving your goals and less about this manager or that stock. I think that's really evolved recently, and you hit it right on the head.
Yeah, I think if and take it from personal experience, if you ever get in front of a client and start talking about Sharpe ratios and skewness and kurtosis and standard deviation, they're going to glaze over.
Yeah,
So focusing more on kind of what are we trying to accomplish? What's in your financial plan? And how is what we've built going to actually accomplish that financial plan? That's a much better conversation. It keeps people invested longer. It may not be the most the sexiest thing to talk about because we're all analysts at the end of the day and we want to talk through the technical, but that's for the investment conversations internally. Keep it very simple.
I love it. Fantastic. So when we've been talking about how alternatives, the impact they have on portfolios. When are alternatives not appropriate?
Yeah, it's a really good question, and I think it's an important one for us at CAIA as we're building this education, and And I should say, like when we build these programs on UniFi, like we're bringing in views from the entire industry. We've got very senior professionals across some of the largest asset management firms, the largest global banks, the RIAs, and so it's a conglomeration of all these different views. And even if these people compete by day, they are coming together because they realize that questions like you're asking here, when is it not appropriate? It's important to have answers for that.
Mhm.
So we talk a lot about this, both on the upside and the return perspective of what alts can bring to your portfolio.
Yeah.
But then there's also important considerations when alts are not appropriate for your portfolio, or certain parts of certain parts of alts are not appropriate for your portfolio. So I think a couple of instances are pretty clear that alts are not a good solution for you. So one is if you don't have the tolerance to stick with it. These are long-term
Mhm.
investments, typically illiquid in
Yeah.
most cases. And so whether it's your client or it's your firm, and I think it's important to distinguish between the two. Clients are one part of the conversation. And again, if you're stepping back and not focusing on certain asset classes or managers and you're focusing more on the plan, clients might be more willing to invest in some of these strategies. But then you also have to take a step back and say, is my firm willing to stick with this? Do I have
Mhm.
the capability to ride out difficult times? And I think that's important to kind of turn and look inward and self-reflect as an organization. I think the second is if you don't have the operational expertise or the access to managers. This is such an access-oriented part of the industry. The top performing managers versus the bottom performing managers, there's a wide dispersion of outcomes. And so if you're not even set up to succeed, I think that would be a reason to maybe take a pause or maybe even focus on certain portions of alternatives and not go in wholesomely. But on the operational side, it's also how do you set up compliance? How do you set up paperwork? Are you willing to kind of do things a little bit differently? Because to be honest, the past 10 to 15 years, we've seen a lot of improvements in operations. It's very easy to invest a basket of ETFs or mutual funds. And, I think setting up operations is an important consideration. And then third, and I think maybe most important, is your client profile. So even if your client is willing to invest in some of these strategies, if you're working with a lot of retirees who are in decumulation phases, certain asset classes are not going to be appropriate. And some, in fact, may not be appropriate at all. If you're constantly pulling capital out of the portfolio, you shouldn't be investing a big portion in venture capital, for example. So I think client, maybe in reverse order, client profile, operations, and access, and then your clients or your willingness to stick with it over a long-term investment horizon.
Great, Aaron. I love that you brought up about, the firm too. I don't think people think about that, financial advisor. It's like you want to include it, but is the firm going to support you? Do they have that infrastructure to support you in that process and the client? I think that's very important, and one that I guess I haven't heard of lately, but that's fantastic. And then, a lot of times I feel as if, alternatives or private equity, it's such a, sexy term, and people are like, let's just do it, and, all the benefits. But part of me is too is you don't want to just invest in alternatives just for the sake of investing in alternatives, right?
Right,
You got to
right.
have a process in place, like you said.
Yeah, you've got to have a process in place, and you have to realize that, especially if you're going into an asset class for the first time. So private equity is a really good example. It's not a one and done investment. You've got to invest over multiple vintages. You might need to consider different vehicles, and so this could be a multi-year ramp up
Mhm.
period where you're investing in new funds, new vintages. And you're not really getting the pure kind of exposure until maybe 5 years down the road when you've got multiple funds and multiple vintages, and you're getting more broad exposure of the private equity industry, for example. So it takes some time and investment, and it can be worth it for a lot of portfolios. we have to go in and with eyes wide open.
And a lot of my conversations I've had with people over the course of the past 2 years, it's, one common theme is know what you're investing in, right? For
Yes,
your
absolutely.
for your client, whether it's just a mutual fund, know what is in that mutual fund. Are you really getting a diversified mutual fund when 30% of your assets are tied in the Magnificent Seven, right?
Right.
Know
Right.
what you're investing in. I think that's key across the board.
Absolutely. Absolutely.
Thank you so much, Aaron, for coming on the show. It's such a fantastic conversation. You brought a lot of great insight and information that I know I learned a lot from in an asset class or investment that can be, kind of confusing. And I love the fact that you talked about, maybe remove the word alternatives and just focus on whether it's private credit or whatever that asset class is, and focus on that. Such great insight and tips. Where can our audience get more information about UniFi by CAIA?
Yeah, so I would encourage you to go to our website. So it's www.caia.org. And you can learn about UniFi, our CAIA designation under the programs tab. But we also have a lot of thought leadership and content that's free to the industry. So white papers, our blog, webinars, our chapter events around the world. So there's a lot there that if you're just getting to know us or you just want to get some good primers on alts, I would encourage you to check that out. And then those formal programs are available with information on the site as well.
Fantastic. I've gone to the website quite a bit. I should just do it, but I've often thought, I should get the CAIA designation, the charter. It's so valuable. I see how many people do have that charter now. I see it more and more often. Roughly, how many people have it? Do you know,
Yeah,
Ryan?
we have 14,000 members,
Okay.
so 14,000 charter holders globally in 100 different countries, and 55% or so in the Americas, so across LATAM, Canada, and the US, 30% across EMEA, and the balance is in Asia Pacific. So a globally representative group, asset management, GPs, LPs, institutional wealth management. So it's a very broad group of professionals.
Yeah. Well, you guys are doing fantastic work. I'm always a big fan of education. And I love the fact that you've got UniFi to help educate people on alternatives that, maybe they don't want to go get the designation, but you're providing information out there for people to learn more about. Great stuff. Thank you so much for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel, iHeartRadio, and Spotify. Lastly, please give us a follow on the Zephyr LinkedIn page to learn more about Zephyr. Thank you very much and have a great rest of your week.
Thanks, Ryan.